Stocks were up most of the session, but then we had a late day sell-off as we found out that President Trump was going to hold a press conference regarding China here tomorrow on Friday. We also heard from President Trump late this afternoon regarding some social media practices, and that might be affecting stocks like Facebook and Twitter and so on. So all in all, it was a pretty quiet day as the S&P 500 finished lower by just 0.21%, and we continue to have a bullish posture on the overall market. So we'll take a look at all of that, and then we'll take a look at a trade application example with a stock that we've actually done a trade application with here in the last few months. It's continued to work. It continues to be in an uptrend and looks like it's set up for a pretty nice bounce. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 28th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, and while you're there, check out our description area where you can sign up for our email distribution list. In addition to that, we're heavy users of Twitter. Feel free to follow me at Brandon Van Zee. And thanks to all of you that click like and retweet on these Market Outlook related posts. Lastly, we do have a Facebook group as well. Feel free to join that group by going to the web address embedded in that link or in that logo there in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. And as you can see, the S&P 500 was down 0.21% today, with a little bit of a upper shadow on that candle there, suggesting that we did have a little bit of an intraday sell-off. The Dow Jones was down 0.58%. That index was up this morning fairly nicely on some positive news that Boeing was going to restart some production, but ended up giving up those gains near the end of the day as well. And then the NASDAQ was off by 0.46%. Remember, the NASDAQ had been our leading index here in the last several months, but more recently has kind of taken a back seat to some of those more value-oriented themes. And then last but not least, the Russell 2000, as you can see, was down by 2.48%. So quite a bit different than the other three indices. The small caps were down 2.5% here today. Now keep in mind they are pushed around a little bit more easily, so you do see a little bit more extreme price movement. So I wouldn't read too much into this. The small caps have actually had a very nice run here recently. You can see ever since bouncing off of their rising 30-day moving average at around 1222, we've gone all the way up to 1400 here in just a couple of weeks' time. So that's a pretty significant percentage increase that we're seeing there out of the small caps during that particular time period. So a little bit of a give back here today. Obviously, things suggest that we continue to go higher with all of these indices, but even with the Russell 2000, which up until more recently had been a laggard. So it's really just in the last couple of weeks where it kind of was looked at as a leadership area within the market. But you can see how far and how high we are above that moving average right now. There's a pretty good chance that if this was an important transition day today, which it very well could be if you look at the candles for each of our four indices, this might be a time where we give back a little bit within the market. But even if we do, I think there's some optimism here that we can have another kind of a bounce type of a setup similar to what we achieved back here on the Russell 2000. So in other words, give back a little bit of those gains, but then kind of regroup and establish higher lows and higher highs going forward. The other thing I'd point out about that Russell 2000 is you can see that it did close with what's known as a bullish intermediate confirmation signal because the green line is considered bullish as it's in the upper reversal zone. You can also see that at the same time, the red line, the momentum line, is in the lower reversal zone. So that constitutes your bullish intermediate confirmation signal. And remember, that's kind of a buy the dips type of a signal there. However, we do look at that blue line to try to determine if it's an ideal setup or not. And in this case, it would not be considered an ideal setup. The blue line, as you can see here, the near-term line is at 70.86. We like that number somewhere between 50 and 20 for a more ideal buy the dips type of a situation there. Yes, 2.5% is a decent sized dip, but considering how much we had gone up prior to that, you might require a little bit more of a pullback before getting too aggressive with a buy the dips mentality. So I'll let you decide on that, but maybe you dip your toe in a little bit there with a smaller position size and then get a little bit more aggressive if a more ideal setup establishes itself here a little bit later. But otherwise, we've got some pretty bullish markets on our hands. I didn't get a chance to listen to David's video last night, but I'm sure he's been kind of talking about some of the movements, the undercurrent of the market, and some of the rotations that we've been seeing here more recently. In fact, let me pull up our website here real quick. Here's the factor selector tool that we use for my swing trading class on Wednesdays. And in this particular graphic, we did see an important transition that took place on a week-over-week basis. We saw momentum stocks slipping here week over week. Momentum had been number one for 3 straight weeks. There's been some sort of a change that's taken place. I think a lot of you have probably felt it as well. Today kind of reverted back to some of those momentum stocks again, but in days prior to today, we saw those momentum stocks in some cases just stay out of the rally altogether. Some cases they sold off. Other cases they just underperformed. But what we did see is a big move out of value stocks, and you can see that right here as well. Value went up on the rankings on a week-over-week basis at the exact same time momentum fell in the rankings on a week-over-week basis. So a lot of those banks and other financial companies that were stuck in that value category, they've had a heck of a couple of weeks here. There's some banks and some insurance companies that we've been following in my premium classes that are up 20% in just a couple of weeks here, and that had not been the case. Many of the financial stocks had been laggards even in this rally that started in mid-March, but that all changed here in the last couple of weeks. We'll keep our eye on that story. You know, I will say that there has been times in the past where that has happened. I think it was last either August or September where we had a very similar situation there. So anyway, this is something that we've gone through before, and it hasn't really led to much, but at least we'll identify it for you here in the video, and that way if it does start changing, we can, you know, get a little bit more, posturing towards that kind of theme and pushing maybe more money into that theme. Now remember, we've got some of that stuff going already. Some of you recall that speculative trade that I did a couple of months ago regarding Discover Financial. And I said it was a highly speculative trade, and it was, you know, we were going out a couple of years with the Leaps call options that we were purchasing. But I said it offered really big upside reward if it worked out, and so far it has. That stock has really erupted here. It's at its highest levels here today since early March. And so, of course, when you've got leveraged calls to the upside on that type of an underlying stock move, it helps even more. So we do have some exposure to that value area already, but if that continues to work its way up the rankings, we might very well continue to push additional funds into that area because it has been so out of favor that there is a lot of catch-up room available for many of those banks and brokers and other value-oriented financial stocks. We'll keep our eye on that for you. Make sure you continue to tune into these videos as time goes on. All right, let's get back on track over here with our charts, and let's take a look at the 3 green arrows setup now. And so that's chart 4D. And you can see here that we do have 3 green arrows on 3 out of our 4 charts right now. Some of you that follow me on Twitter yesterday might have seen my tweet about Gerald Appel, who was the mastermind behind the MACD. Unfortunately, he had passed away, so he was a true pioneer when it comes to technical analysis. He'll be missed, but that MACD is part of our 3 green arrows philosophy that many of you have watched right alongside with us for many years at this point. And so it is the MACD histogram in this case for the NASDAQ composite that is the fly in the ointment. That's the only arrow out of these 4 charts that currently is red. All the other charts have 3 green arrows, and even on the NASDAQ we still have a green arrow on the moving average, and we still have a green arrow on the stochastic. So really it's just a little bit of a loss of momentum. And again, that goes back to what I just showed you there a moment ago with the factor selector, where we're seeing momentum take a back seat to some of these other themes within the market that have improved. And remember, the NASDAQ composite is notorious for having a lot of high-tech companies within it. A lot of those high-tech companies benefited from the whole work-from-home phenomenon. And since that has been kind of out of favor in the last couple of weeks, we saw an actual loss of momentum in the NASDAQ itself, the NASDAQ composite in this case. So we'll keep our eye on that. It's not something that we need to really sound an alarm on at this point because because it's still trading above its rising moving average, but just be aware of it. There's a weakening that's taking place there on the NASDAQ composite, which we hadn't really seen all that often in the past unless all the rest of the indices were also weakening. So this is kind of a rare moment where the NASDAQ is weakening, but we're not really seeing that across the board in the other major market indices. All right, let's go ahead and now take a look at our 12 grid analysis, starting with 5A. This will be our asset class 12 grid. And a reminder, we talked about this a little bit in my question and answer session for premium students earlier today about how you read the various charts that we have here. And when we're on chart 4A, that will show you the background changing colors based upon whether we have a bullish or bearish posture using that market forecast technical indicator. Because the 12 grid has such miniaturized charts here, it would look a little peculiar to have those background colored changing every couple of days. It would just kind of splice it up too much, and it would be a little bit too much for the eyes. And so remember, when we're looking at the 12 grids here, there's just one color, and that one color of the background represents whether the current posture is bullish or bearish. It's not saying anything about what the posture might have been yesterday or the day before or what have you. So just be aware of that slight nuance there. And again, I did discuss that in my Q&A class here today, so feel free to go check out that recording if you are a premium member and you want some more information on that. As we look at this first set of 12 grids here, you will see that there's a mix of green and red charts on the board. Worth noting is that when we're looking at the two pink charts, two of them are dark pink, two of them are light pink. And it shouldn't be a surprise that the two that are light pink are doing better on a price basis than the other two. At least what I can say about that in the last 30 days. In other words, both of them, in this case, the EEM up here at the top rung is trading above its rising moving average, and we have gold up here, or down below here, trading above its moving average, which is now falling slightly, but it's priced above it. Whereas when we look at long-term U.S. Treasuries and the U.S. dollar, notice their background color of the chart is dark pink, suggesting that we have a strongly bearish posture, not just a weakly bearish posture like the other two. And it makes sense because if you look at the 30-day moving averages, in each of the case of the long-term U.S. Treasuries and U.S. dollar, price is below a falling moving average. So there's been less ability for those charts to rise over time, regardless of what the current posture is. With emerging market stocks and gold, they've had more of an ability to rise over the last 30 days or so. It's just that this moment in time happens to be a little bit weaker for them from a posture perspective. In terms of the other green charts on the board here, the U.S. stock market, of course, continues to chug along. We actually did have the highest intraday level on the S&P 500 since going back here to, I believe it was this candle on March 5th. Now, again, we sold off to end the day. We were down, 0.2% or whatever it was. But earlier in the day when we were higher, that was the highest point we had traded at since basically that first week of March. So, this has been a very consistent and persistent bull move since the lows here in mid-March. And it's probably frustrated a lot of people. In fact, I know that it's frustrated a lot of people as it just doesn't make sense to a lot of people that the stock market continues to do as well as it has considering the state of the economy. And remember, those two things can be different from one another in the short term. Oftentimes, longer term, they do act or react to one another. But in the short term, other things like money printing by the Fed can change the course of maybe where those stocks deserve to be. So right now, we're trying to follow the trend and try to stay with more bullish trades than bearish trades. And it doesn't mean you can't take any bearish trades, right? I think David and I have both taken a handful of bearish trades here and there. It's just that we don't want to overdo it because right now the posture says that we're bullish. So we want to have more bullish trades than bearish trades. And that will be the case later on in tonight's video here, as well as I've got a bullish trade idea set up for you. Anyway, you can see that the foreign stock market from a developed perspective, not emerging, but developed perspective, continues to be quite strong here as well. And it is trading at its highest level since basically going back to this gap down after March 6th itself. So both of those charts going back to the first week of March. And you can see a consistent theme of higher highs and higher lows getting carved out there. Remember, there's a lot of banking stocks in those developed foreign markets, a lot of European banks and so on and so forth. And so I think that has helped their prospects a little bit more so, whereas the United States is driven a lot more by technology, especially your big players like your Facebooks and your Apples and Microsofts. So we are not driven in the United States quite as much by the financials as you will see typically around the rest of the globe. And so I think that's really what's kind of spurting EFA along in a pretty nice chart set up here recently as well. Real estate had a decent day. It was up 0.5% there. And you can, of course, see that the 10-year U.S. Treasury is now at 0.70. So obviously very historically low, if you're looking back several years, but, compared to where we have been in the last couple of months, it's maybe trying to break free to the upside just a touch right there. Remember, when Treasury yields go up, that can actually be supportive of bank stock prices as well as the net interest margin could be improved upon. We had that conversation today in my question and answer session as well, as we were looking at a bank stock with more than 25 years worth of dividend increases. And that can be true for insurance companies as well. So if we do start seeing a theme where bonds start selling off, Treasury yields start going up, that will help support this idea that value stocks are going to come into vogue like we've seen here in the last couple of weeks. If that reverses, then all bets are off. So we'll keep our eye on that story. Let's go ahead and take a look at another set of 12 grids now. In this case, we'll go over here to the U.S. sectors 12 grid. This will be chart 5C. So this will be the more standardized market cap oriented version of it with the more liquid ETFs in these cases. And you can see we've got a clean sweep across the board. We have green, green, green as far as the eye can see here in the United States, all of our sectors giving us bullish postures. Now you will notice down at the bottom, we have staples and utilities as the two charts on the board that have a light green background color as opposed to a dark green background color. And so that suggests we have a weakly bullish posture rather than a strongly bullish posture. Nonetheless, I was looking at a couple of utility companies, and there was one I was getting awfully close to buying myself here a little bit earlier, and lo and behold, of course, it turns around here today finally. And so, I'm on the outside looking in on that right now, but on the positive side of the equation, at least it's helping support the rest of the market. And you can see that utilities have actually started to emerge above that rising moving average now. Notice that moving average actually turned green. So this was a big enough move, and this was an aggressive move. I think it's worth underscoring in this case. The utilities were up 3% today. You look at the rest of the market, it was kind of a blah day. There wasn't really anything going on, right? The S&P 500 was effectively flat. Utilities up 3% on a day when the S&P 500 was flat is a little bit peculiar. So maybe somebody saw something to like there. There was some value opportunities emerging after the utilities have largely sat out this rally for the last few weeks, where the rest of the market kept on humming higher, higher, higher. You can see the utilities swooned below that moving average, spent most of the last 2 or 3 weeks below the moving average, and just today and yesterday finally got its head back above it. So we'll see if that can swing us back into favor in some utility stocks. And you kind of have the same impression there with the consumer staples as well. In terms of areas that did poorly today, first of all, there's energy down 2.8%. So that was a pretty aggressive down move there for energy. You did have consumer discretionary down 1.2%. So a lot of that might have been Amazon. I didn't actually check Amazon today, but it does look like Amazon was down today. So down 0.39%. That was likely part of the reason that discretionary was down here today. We also saw technology down. Right? And that's, again, some of those work from home stocks and all of that haven't really been working for investors in the last few sessions. You can see the communications was also down today. So those areas, some of you will recall that a couple of weeks ago when I was doing the presentation, I was saying this is a market right now that's being led higher by communications and technology. And we had looked at their intermediate levels, and they were the highest on the board. that has changed a little bit. They've kind of dipped a little bit, and we now have discretionary as the number one, I guess you would say, at a 94 reading on the intermediate line. And you even have, in the case of energy, the energy's intermediate line is actually higher right now than technologies, if you believe it or not. So, we've actually seen some pretty decent movement out of oil prices here ever since we printed that negative number that caught everybody by surprise a couple of, it might have been about a month ago at this point, I guess. So anyway, good news for the most part with the U.S. sectors. We do have bullish postures across the board despite a couple of those sectors pulling back in price here today. But the big surprise of the day was utilities. After kind of being left out of the rally for so long, they surged 3%, which is a really big move for that often slow-moving sector. So let's go ahead and take a look at another 12 grid. In this case, we'll go over here to the global stocks primary 12 grid. These will be the largest economies around the globe. And of course, one stands out like a sore thumb, and that is China. Not a surprise given the temperature of the headlines that we're taking out there. And again, like I mentioned earlier in the session, part of the reason the market sold off today was after we found out that President Trump was going to have an announcement about China. And the market is now wondering, okay, here we go again, right? There's a lot of chaos and protests and things going on in Hong Kong, and makes us wonder, are we going to get into this, he said, she said situation where we're starting to threaten tariffs with one another again, and if that's the case, that could crimp profits. So, I think the market right now is saying we've got all that we can handle with this whole coronavirus issue when it comes to our economy. Let's take one problem at a time, and if you're going to throw China into the mix all of a sudden again, it could very well be quite disruptive considering the state of our economy right now and all the unemployed folks that are out there. Although I will say that earlier today the unemployment claims did see an improvement in the numbers. Obviously, there's still eye-popping numbers of people that are applying for unemployment benefits, but at least those numbers have been slowly reduced as the last 10 weeks have gone on. And there is some optimism around that with a lot of states loosening up their requirements when it comes to stay-at-home orders, that a lot of people that maybe had been laid off are now getting called back to see if they are available to work once again. And so hopefully that is a good sign for the economy and for those individuals. Clearly, having a steady paycheck coming in is important for family stability and, of course, important for our economy as well. So we're at least heading in the right direction from that perspective. Anyway, as you look at the rest of the charts besides China, we do have green charts on the board suggesting that we have strongly bullish postures. In fact, they're all that dark green color, and none of them are the light green color. So that's an even better sign. In terms of which areas are doing the best, again, judging by what is the intermediate line, what we're comparing it to in this case would be the United States. In this case, the SPX, and you can see that intermediate line is at 91.80. So if you want to look at all the rest of the numbers on the board, you're kind of comparing it to, okay, well, is there anything that's outperforming the United States right now that might be worth looking at least here in the near term? And Germany is one of those. Now, it's awfully close. You could really actually call that a tie. In the end, the S&P 500 is up just a smidge. It's at 91.8. Germany is 91.2. So they're right there in the same general vicinity. Otherwise, you don't really have any others that are able to compete. You do have Russia down below here at 90.66. So, perhaps there's something brewing there with Russia. And of course, Russia has a heavy reliance on energy prices. So maybe the fact that oil prices have been behaving themselves have been an excuse for traders to be looking towards Russia. But otherwise, it still is a United States kind of strength story that's taking place out there. And, again, part of the reason behind that is we had such a surge here in the last couple of months with those mega cap tech companies that it's hard for the rest of the world to keep up when you're creating these $1 trillion monsters out there like Microsoft and Apple. So if that cools off, which we have seen in the last, let's call it week or so, if that continues, if that's a new theme, then we might very well see some of these other areas around the globe starting to play a little bit more catch up and maybe even start to outperform the S&P 500. So we'll keep you tuned on that. But as I look at these various charts, I would say that Japan looks pretty interesting here. Japan's been up for 4 days in a row, and some pretty big leaps and bounds along the way as well. You'll notice some of those gaps there. Now that's pretty normal for a foreign ETF to gap. That's just the nature of it as it kind of reacts to what would have happened in this case in Tokyo's stock exchange the day before. But it is a good sign that we're continuing to power higher there in Japan, and we were up another 1.3% there in Japan today. And in fact, this is actually the highest level for Japanese stocks, at least in US dollar terms, in the last 3 months. Now remember, that's an important statement because as we look at the S&P 500, we still aren't to where we were when we topped out the first couple of days of March. With Japan, we're well above those areas that it was trading at back in the first week of March. So, there may be something to that idea that Japan went through its crisis in terms of the coronavirus crisis much earlier than the rest of the world. Remember, they were one of the countries that really got hit by those cruise ships. In fact, I think I heard that half of the country's cases in one form or fashion stemmed from those cruise ships that were docked there. So they went through it well before the United States did, and probably took precautions after that, and so have maybe enjoyed a little bit more economic stability after the fact there. So kudos to Japan and those of you that are trading those equities there. Let's go ahead and take a look now at the smaller economies there. So we would call this chart 5G, and this is our global stock secondary 12 grid. As we look at these, same story. We got a clean sweep here. So this is a good sign, right? We had a clean sweep with the U.S. sectors. We nearly had a clean sweep with the major economies, with the exception of China. And then we now have a clean sweep here with some of these secondary markets as well. Now, again, same story. Let's compare some of these markets around the world to the United States in terms of how does the market forecast look at it. And here you can see that Australia is very similar to the S&P 500. They're both right up there at around 91 on the intermediate line. So you've seen some robust moves up and off of that 30-day moving average in Australia that you'll want to be aware of. Let's see if there's any others here. We do have the Netherlands, some of my ancestors there that are at least above 90. So not quite to 91 like we saw with the S&P 500, but knocking on the door of that. And you've seen a pretty nice little bounce off the moving average in the Netherlands there as well. And then on that bottom rung, Argentina does stand out. Now, Argentina is still a long ways off of its highs there on March 4th, but this is it's a more extreme mover than a lot of other markets that are out there. You see extreme down moves followed by extreme up moves. And you'll see here we had all those oversold cluster signals there towards the middle of March, and then we just shot higher there. And at this point, we're only down 4% on Argentina over the last 3 months, even though at one point we were down nearly 40%. So that is a massive recovery there from its lows in Argentina. So perhaps some trending opportunities available there. In terms of how the charts look, similar to Japan, Sweden looks pretty impressive to me, and I should have called it out as well. It also has an intermediate line at 92, but I do like how it's kind of gapped higher for 4 days in a row here. And while it's not above its March highs the way that Japan was, it's up in that neighborhood where it wouldn't surprise me if we could get up and through that area here in the coming trading sessions, assuming that we don't have some sort of a global give back across the board. All right, so let's go ahead and now talk about our trade application example for the day. And I had mentioned in the intro that this is a trade that we've actually done before and it worked out for us. So I said, what the heck, let's give it another shot. And that is on Clorox. And I like the way that Clorox is shaping up, and that's not a surprise. I've been talking about my my interest in Clorox not only here but in my premium member classes as well. And I just like the way that it's behaving itself. First of all, if you could talk about a consumer product that kind of describes the current state of affairs the best, you might very well throw a Clorox wipe in there. Now, obviously, some of the N95 masks and some of these also have made a big impact. But without a doubt, one of the big product stars of the coronavirus era has been the Clorox wipes. You cannot get a hold of them. I know because I'm regularly looking on Amazon, and they just are not around. Anytime they hit a shelf in any big box store, they're gone immediately. So this is a company that really has some positive things going for it as a business, despite the tough economic circumstances around it. And you can see that for the last 3 months of this chart, every time it's touched this 30-day moving average, it's only hung out there for a couple of days and then bounced up and off of it. It did it here 3 months ago. It did it here again in the middle of March. It did it here again in the end of March. It did it here again in late April. This is when I was talking to you guys about it a little bit more, because I remember it was right before their earnings announcement. I said this one might be one that's worth speculating on even right before an earnings announcement, because I really like that bounce off that moving average at that time. And then it did pop higher, and now it's had that pullback, and all of a sudden it looks like it's gearing up for another bounce yet again. And you can see that we do have a bullish near-term posture on it. That's what that blue background color of this chart means. You can see it's easily outperforming the S&P 500 over the last 3 months. You can see that the intermediate green line on the market forecast is at 65 and rising. So in other words, trend traders and swing traders could find something to like about this particular chart. Now, how you go about taking advantage of it is always up to you. One way to take advantage of it, and the way that we did it last time, was by selling a bull put spread. And that's what I'm going to kind of set my sights on once again with this one, to see if we can have some luck on round 2 of this particular trade. So let's go on over here to the trade tab. You can see I've got it pulled up already down below here, and I'm using July monthly contracts here. So this would be the contracts that have 50 days until expiration. What I'm using for my sold strike is 195. So that's the 195 put that I'm selling, and at the same time I'm buying the 190 put. Remember, when we buy the 190 put as part of that, we're basically building in a hedge into our trade just in case this doesn't go the direction we want and it starts plunging. We have some protection embedded within the trade itself. Otherwise, we're going to take in $1.17 of credit here for basically making a bet that we don't think Clorox is going to close below 195 on July expiration here 50 days from right now. Now, you can see I'm getting $1.17 of credit. If I hit confirm and send here, it would allow me to get my calculator out, and I could take the current max profit that it's showing me on that order confirmation of 117, just doing one contract here for paper money practice purposes, and dividing it by max loss of 383, and you can see that that gets us our 30% return on risk that we often strive for. Now you can also see on here that the break-even price is 193.83. So that's where we don't want it to cross below if we want to make a profit on this particular trade. So I'll show you that again on the chart here in just a second. So 193.83, let's send this in, and I'll show you over here that 193.83 is right around there. In other words, basically, if you believe that this bounce that started yesterday has some oomph behind it, and it's going to take us to higher levels just like these prior bounces have, then you're going to assume that yesterday was an important low for this stock after it had fallen for about a week and a half there, and then yesterday was the bounce day and continued up an additional 2.5% today. So that's kind of your bogey there, and you can kind of see that old resistance becomes new support, right? This was the same area that it had resistance at back here in mid-April that also acted as support here yesterday, and that will also be where our break even of this trade will reside. So again, it's a bullish trade where we just simply want the stock to stay basically above $194. And as long as that's the case, then we get to keep that premium that we took in, $117 to start that trade. All right, well, I want to thank you for joining me here yet again. Of course, David will be back with you tomorrow. Hope you guys got some value out of tonight's presentation. If you did, the way to show your appreciation and to encourage us to do the video again tomorrow would be to go on over to Twitter and click like for us there. I'll have it posted or pinned to the top of my Twitter timeline. Thank you so much, and we'll see many of you tomorrow in my Options for Long-Term Investors class. And of course, David will be having his very popular technical analysis trading room tomorrow mid-morning for those of you that are premium members as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.